When you glance at your banking app, that balance feels pretty solid, right? It's instant, accessible, and feels secure. But what if I told you that number on your screen is less like a pile of cash and more like an IOU? The truth is, your money isn't just sitting in a vault with your name on it. The moment you deposit it, your bank is legally allowed to start putting that money to work in a race to make a profit from your funds before you ask for them back. Today, we're pulling back the curtain on the modern banking system. We're not just talking about a few fees. We're re-exploring the powerful and incredibly profitable engine that turns your savings into the bank's revenue. So, have you ever really wondered how your bank actually makes money? By the end of this, you might not look at your account the same way again. Section 1. The main engine, the interest rate spread. The biggest way your bank makes money is through a concept that sounds like financial jargon but is actually very simple. The net interest margin. Let's break it down. Imagine two people, Sarah, a saver, and John, an aspiring entrepreneur. Sarah deposits $10,000 into her savings account. She's not using it right now, so she lets the bank hold it. In return, the bank pays her a little bit of interest. Let's say 1% a year. After a year, Sarah has her original $10,000 plus an extra $100. A safe, if small, return. Now, here comes John. He has a brilliant idea for a coffee shop and needs a $10,000 loan. He goes to the same bank, which sees an opportunity. It takes the $10,000 Sarah deposited and lends it to John. But it doesn't charge John the same 1% it's paying Sarah. Instead, it charges him a higher rate, say 6% a year. At the end of the year, John pays the bank back the $10,000 plus $600 in interest. So let's do the math. The bank got $600 from John but only owes Sarah $100. That $500 difference is the bank's profit. That gap, the difference between the interest the bank earns on loans and the interest it pays on deposits, is the net interest margin. Your bank does this millions of times a day with billions of dollars from all its depositors. For most commercial banks, this is their number one source of revenue. The economy plays a huge role here. When central banks raise interest rates, banks can often charge more on new loans faster than they raise the rates for savers, widening their margins and profits. While margins are always shifting. Large U.S. banks typically have net interest margins between 2.5% and 3.5%, while smaller community banks sometimes reach higher. It's a numbers game on a colossal scale, all powered by the money you think is just sitting in your account. Section 2. The hidden and not-so-hidden costs of banking. If the interest spread is the bank's engine, then fees are its rocket fuel. While you earn a little interest, banks have a whole playbook of charges designed to generate steady income. For the U.S. banking industry, this non-interest income has historically made up around 35% of total revenue. Let's start with the obvious one, the monthly maintenance fee. This charge may cost $5 to $25 just for having an account. Banks often waive this if you keep a minimum balance or set up direct deposit. Why? Because both of those things give the bank a stable chunk of your money to use for its lending machine. Then there are the fees that sting the most: overdraft fees. A $5 coffee can suddenly become a $40 mistake if it pushes your balance below zero. In recent years, public and regulatory pressure has pushed many banks to reduce or even eliminate these fees. Some major banks like Capital One and Citibank have gotten rid of them completely. But for many institutions, they remain a significant source of cash. But the list doesn't stop. Ever used an ATM that wasn't your bank's? You probably got hit twice, once by the ATM owner and again by your own bank for using an out-of-network machine. That's easily $5 or more just to get your own cash. There are also fees for paper statements for not using your account enough, for closing an account too soon, or for using your card overseas. And behind the scenes of every card swipe, there's the interchange fee, a small percentage of your purchase that the store pays to your card issuing bank. You never see it, but it adds up to billions for the industry. These fees aren't just about making money directly. they also guide our behavior, encouraging us to keep our money right where the bank can use it most effectively. Section 3. The aha moment, the system that makes it all possible. So, if the bank is lending out Sarah's $10,000 to John, how is the money also there for Sarah if she wants it back? This is the aha moment of modern banking, and it's all thanks to a system called fractional reserve banking. The name sounds complex, but the idea is simple. The bank isn't required to keep all its depositors' money on hand. It only needs to hold a small fraction of it. The rest, it's free to lend out. Let's go back to our example. Sarah deposits her $10,000. Historically, a bank might have been required to keep 10% in reserve. That is $1,000. That money stays in the vault. But the other $9,000? That's what the bank can lend. But here's a wild fact. Since March 2020, the Federal Reserve has set the reserve requirement ratio for U.S. banks to 0%. Even with no minimum requirement, banks still need to manage liquidity to ensure they have enough cash for withdrawals. The principle of fractional reserves still drives the system. The bank lends out that $9,000 to John. John deposits it into his own bank account to pay for his coffee shop. And just like that, Sarah still has a $10,000 balance, and now John has a $9,000 balance. One deposit has multiplied the amount of money in the banking system. This money multiplier effect continues. John's bank takes his $9,000, holds a part of it, and lends out the rest. That loan becomes another deposit, and the cycle repeats. Sarah's initial $10,000 can end up supporting tens of thousands of dollars in new credit throughout the economy. Banks operate on the high statistical probability that we won't all demand our money back at the same time. When you check your balance, you're not looking at physical cash. You're looking at a highly trusted IOU from a bank that's using the real funds to power its profit machine. Section 4. The big leagues: investment banking and financial services. For the world's largest financial institutions, the story gets even bigger. While commercial banking is their foundation, the truly massive profits often come from their more glamorous divisions: investment banking and wealth management. Unlike your local branch, an investment bank's clients are huge corporations, governments, and institutional investors. These clients pay enormous fees for high-stakes financial services. A major one is underwriting. When a company wants to go public with an IPO, an investment bank acts as the gatekeeper, buying all the shares from the company and taking on the risk of selling them to the public. For that service, they can charge a fee of 4% to 7% of the total deal. On a billion-dollar IPO, that's up to $70 million for the bank. Another huge moneymaker is mergers and acquisitions, or M&A. When one company buys another, they hire an investment bank to advise them on the deal, charging tens or even hundreds of millions for a single transaction. On top of that, big banks run enormous trading desks, buying and selling stocks, bonds, and currencies. Then there's wealth management, where the bank manages the fortunes of the super-rich, charging a fee on their total assets. Managing a $100 billion portfolio with a 1% fee generates a steady $1 billion in revenue a year. While these activities seem far removed from your checking account, the profits strengthen the entire bank, allowing it to expand all of its operations. It shows that your neighborhood branch is often just the public face of a global financial empire. So, your bank is much more than a simple vault. It's a dynamic business designed to use every dollar you deposit to generate profit. It starts with the interest rate spread, profiting from the gap between what it pays for your money and what it charges to lend it. It adds to that with a whole menu of fees, creating a reliable stream of income. The whole system is built on fractional reserve banking, allowing your deposit to be multiplied into new loans throughout the economy. And for the biggest players, this is all turbocharged by the world of investment banking, where billions are made from corporate deals and managing vast fortunes. The number on your screen is a claim on cash in a system that is always moving, always working, and always profiting. What's your experience been with bank fees? Ever been hit with a charge that caught you by surprise? Let us know in the comments below. If you found this insightful and want to learn more about how money really works, hit that like button, subscribe, and turn on notifications so you don't miss our next video.